Investor Update. I hope you've had a great day today, great week so far. For those of you who are fathers, I hope you had a wonderful Father's Day weekend and that you're able to celebrate that time with family and friends, children, grandchildren, and that you enjoyed yours as much as I enjoyed mine, because I had a great Father's Day weekend. To the clients who are used to this event, how we do this every single month, we're glad you could join us again, and that hopefully tonight you'll get some new information that will make this valuable and useful for you. To the guests, this is your first time being here. We welcome you, and we're going to take some time tonight to try to add some real value to the wealth management components that you're trying to do in your life. As you can tell, we call this your financial journey. And I was just sharing with someone today how we see this as a journey. Up the mountain to that time of retirement or redirection, back down the mountain to that time where you are distributing and pulling wealth out to meet your living and lifestyle needs. And then that point, that final phase where you transfer assets to your loved ones. So that financial journey, we try to help you all along the way to make the most of it by helping you to consider how to create, grow, protect, and preserve your family's wealth in today's economy. And I know that as I've talked to some of you, today's economy is a little more concerning to you. And so hopefully tonight you will have some answers that'll help give that peace of mind and even some confidence going forward and what that might look like. So let me go ahead and get started. Again, for the clients who are here and used to this, we always have these disclosures up here. But I'd remind them, as well as any guests, that you need to take everything we're going to talk about tonight and consider it in light of your financial situation, whether it's investment strategies or risk management strategies, whether it is tax ideas or estate design ideas, planning ideas, etc. You need to consider those in light of your situation. I've never met in the 3+ decades of doing this industry, being in this industry and doing this business, I've never met anybody who's exactly like anybody else. Every day is a different day and every situation is unique. So please take time to make sure that what we're looking at makes sense for you. Towards the end of the workshop, if you have questions, certainly you can raise your hand, or you can chat, write your questions in the chat box, and I'll be happy to answer those for you to help explain what's going on or answer particular questions that you might have. I would encourage you that if it's more personal to your situation, maybe use the time at the end to schedule a phone call or a webinar or an in-person meeting where we can talk in more detail about your situation. But for the more general kind of questions, please take time to either raise your hand or to make note in the chat box, and I'll be happy to take time to answer those at the end of our presentation tonight. So tonight, what we're going to go over is, again, kind of reminding you of what we believe so far and building on previous discussions. Take a quick look at market and economic reviews. I remind you of potential exit strategies when we have a recession, which I think it is obvious we're going to have one. Although I've heard rumors from some in the administration, they think it might not happen, but we'll see. I think my mind is that we probably will have one. I think it's more the question of when, but we're going to talk about how to handle that and what we're going to do on our side and try to bring that together for what you need for us to do for your side. Portfolio management diversification options, we'll take a look at number 4, as well as I'll remind you of our new website and the educational programs that we're putting into place between now and the end of this year. Remind you of the wealth management apps that I've been so excited recently how many of you have said, hey, I'm not using this app or that app and I need to start using that. So again, I'm excited about how some of you are really starting to understand the power of what we're putting in your hands. After that, we'll take time for your questions, and then I'll remind you of our next update and tell you a little bit about what I think that's going to be about. So with that in mind, again, kind of what we have talked about before. Last webinar, I went over the good, the bad, and the ugly, and while I know that I've got the categories backwards here based on the titling, the ugly, I feel like most of you know what the ugly is. The price of oil, unresolved supply chain issues, empty shelves, Babygate, hard time getting appliances, furniture, etc. Rising interest rates. We saw the Fed raise interest rates 0.75%, taking a much more hawkish approach here this month. Recession and or potential stagflation and what that might mean. We're going to talk a bit more about number 4 to show you why I think that that is a reasonable concern or thought, but at the same time, by no means is it a definite. The bad, again, sometimes we think that the policies of the administration seem a little off. I wrote down cuckoo for Cocoa Puffs last time because it just made me laugh, but truthfully, again, it's not an administration. I think any administration, their politics are one aspect of it, but it's honestly more the policies I'm watching for. And that seems to me there's some policies that maybe don't line up as well as what I'd like. The question becomes how long-term and how deep those policies go in terms of what's going to happen as we look at future elections and so on. Obviously, Secretary of Transportation policies, Secretary of Energy policies, Secretary of Homeland Security policies, and as I mentioned last time, the end of quantitative easing, and we have clearly moved into quantitative tightening, which I think is another one of the issues that's a little bit frightening to people, because we've had this giant wave of money that's been crashing into individuals and companies, and that now has pretty much stopped. And so now we're getting to see what the economy looks like without the government handing over more money. So that'd be the bad. The good, inflation should improve at some point here, whether it's next month or this summer or the fall or the winter, inflation will improve. It always does, always has, and there's no reason to think this time is going to be any different that way. Also, the 2022 midterms, probably going to be a wave of some benefit there for conservative politicians. And I reminded everybody last time about how Newt Gingrich changed Bill Clinton's presidency because the new Congress, the new House and Senate put a real dampener on some of those policies and put other things in place that made it so the economy was able to rev up faster. Resolving the supply chain issues, both domestically and internationally. We see more and more of that happening, which also will serve to rev up the economy. The return of business competition. When businesses have their supply needs met and they can then meet the demand of their customers, then we're going to see competition start to kick in, which will then help to bring price hikes back down a bit. How far down, we don't know yet. It's going to depend on many factors, but we are seeing that competition is starting to show itself, and I think it's just going to continue to grow and become bigger. Quantitative tightening, which I said a moment ago is a bad, but it's also a good, because the reality is that when the government gets out of the way, then you have the free marketplace, the free enterprise can now take over and start to function. And there are many going all the way back to 2007 who would say, if the government had gotten out of the way, it might have been bad for a while, maybe even a little worse for a while, but in the end, it would have been stronger and better. Now we get to see some of that because the Federal Reserve has kind of run out of their tools right now, and they have to prepare for some other events that may be coming in the next decade or so. So consequently, they've stopped easing the flow of money and the printing of the dollar and the buying back of bonds and lowering interest rates. They've started doing the reverse. That tightening is now going to make it so we can see the potential power of the US economy. Could it create a recession? Well, it has in the past, and it could this time as well. But overall, I think that when the government gets out of the way, it is better in the long term for the free marketplace to function. Rising interest rates, while it's bad for corporations and for buying property and other things, it is good for seniors because that is a way for them to draw more money off of their cash reserve, off of their longer term CDs and bonds. That is a better deal once that interest rate hike has hit its pinnacle. Record levels of individual and corporate money. The M2 money supply is, as I mentioned last time, at an all-time high. And that wave of money that's sitting there right now, while the government may not be printing or pushing out more money through quantitative easing, that money will start to work its way back into the economy as we see other pieces starting to show themselves. And then finally, I'd go to the 2024 elections and what's going to happen there, because that could have a big impact as well. We've seen bad policies and administrations functioning poorly, and then we've seen through that on the other side how a wave of voting and people's energy to get more conservative policies in place. We've seen that happen at least two times very strongly, and now we might be seeing a third one after this election is over, when this presidency has run its course. And hopefully by 2024, we might be able to see all of that. Now, the point is, you might say, well, that's so far away, but I would suggest to you that things happen both terribly slow, but incredibly fast. And sometimes those pieces all come together. And so hopefully tonight, I'll be able to show some support for that. As I mentioned to you before, and I've said this several other times, while there's a lot of lagging indicators we can look at, the four primary engines of our economic growth, or the four leading indicators that kind of tell us what's happening, is GDP growth, business profitability, unemployment rates, and interest rates. And at this point in time, if you think of those four engines as pushing the plane forward, GDP growth was slightly negative. You could almost say flat. If we had a 1.4% growth, we'd call that flat. So a 1.4% loss, we'd call that flat. As we come out of this second quarter, we're going to get to see, do we have another flat quarter? Does it get worse? Does it get better? Which would have some impact on whether we think there's a recession or not. But for the purpose of this, since we don't know what Q2 looks like, I just simply put down as a negative at this point, even if I think it's a minor negative. Business profitability still continues to be high. And I know that there are a lot of people are looking at the stock market and so on and saying, well, how can this be possible that businesses are being profitable? They are. And they're doing quite well, to be honest with you. Their share price is down, but their earnings are up. And not every one of them, but many of them. There's some corporations who've had some bad policies that they've been operating with. Their profits are down, but there's others who've been doing a great job. And a lot of what drove the market up were the tech stocks. Well, part of the reason the market's taking such a hit is because those same stocks are being pulled back in valuation. And so business profitability and stock market price can be two separate things. Bottom line is business profitability is still chugging along pretty nicely. Unemployment rates are pretty low. We actually have more jobs than we have people who want those jobs. So that underemployment issue is an issue that we have to deal with, but unemployment rates, as you'll see here tonight, are low. That's a good sign. And wage growth is actually up. Having said that, I know that inflation is eating away at a lot of it in some terrible ways. But again, once that inflation goes away, that's going to have a positive impact as well as we go forward over the next quarter or 2 quarters or 3 quarters. Interest rates, as I mentioned a moment ago, they're rising. The Fed's trying to help slow down inflation and kind of forestall that inflationary impact. And so while it's a negative because interest rates are rising for businesses and for people trying to purchase, make capital purchases, it's also a positive for people who are, for the first time in a long time, seeing any sort of higher interest rates on their short-term or longer-term money. So these engines are functioning and the plane is still flying. And so what we want to do is see how do we think it's going to fly into the headwinds or the weather or the blue sky of what's coming next. So as I've talked to you about before, when we look at the asset allocation chart, the asset class returns, and I know this is probably hard to see. I don't know if you can maximize your screen and maybe even expand it a bit so you can see this. But the reality is that looking at this, and this particular asset class returns chart is showing us from, this is actually updated as of June 16th. So it's not so terribly long ago in history that we're seeing this. And so if I'm looking at it here, what I would see is that year to date, now you may see up here across the top, this is 2007. This is going forward to year to date as of June of this year. And one of the things you'll notice, these white boxes, the asset allocation models, you can see where they were on each given year as how they compared to, say, the top performers in those groups, which could be emerging market equities or fixed income, emerging market, real estate investment trusts, small cap stocks, small cap. You can see 2018 cash was the best performer, large cap stocks, small cap again REITs. Commodities so far this year are the big winner so far this year. That doesn't mean how the year is going to end up. 2018 looked like a fantastic year until we got to the last quarter. 2022 could look like a terrible year until we get to the last quarter. So with that in mind, what we want to do is take a look at how do we approach this to create the best model for you, both in protection against risk or drawdown, and yet opportunity when it does show itself. So as we look year to date, what we can see is commodities have done the best at 31.9% so far. Cash has also been a good, I'm not a good performer, has been positive, 0.1. Fixed income, a -11. Asset allocation, even though it's more well diversified and balanced, has been -15.2. We go to high yield, down 15, negative. Emerging market equity, down 17. Domestic markets, meaning the US and other developed countries, I said domestic, I meant developed countries, have been -19 for their major companies. Large cap down 22, real estate trust down 23, small cap down 26. As we look at that, we recognize that right now it's kind of turned upside down. Matter of fact, you don't see a single year where small cap was at the bottom. Matter of fact, it's at the top quite a bit up here. We find REITs also at the bottom, and we see normally they're up here at the top. Certainly, we can take a look at large cap stocks, which are up here in the top 2 or 3. So right now, things are definitely problematic, but we're halfway through the year, and there's a lot that can change, and that's what I want to talk about now as we break this out a little bit. So let me take this, and oh, that's not what I wanted to do. Let's go back here again. Okay. So now, as I let's see here. All right. So this is one of the reports that we use from JP Morgan. I accessed this last time to talk with you about, but I'm going to pick up some different pieces this time around because I want to remind you of a few things that I think are sort of critical to this discussion. And the first is to notice these inflection points. What you're looking at here is going back all the way to 96. So we saw in 2000 we had a real nice upturn, and then all of a sudden everything goes south. We happen to have 9/11 happens, the markets, the economy falls apart, probably greatly due to the fact that so much corporate spending had been done to get everything ready for Y2K. So we had a pullback. That pullback then started to turn positive, and from 2001, early part of 2002 to 2007, we had another run up. But I would point out to you that notice, really in that period of time, if a person had just stayed invested the same way the whole time, they really wouldn't have made any money. This would be the S&P 500, not counting dividends, just looking at S&P price point, it would have been flat growth. That's why we have to have some plan, some process for how we handle downturns and then how we take advantage of upswings. We go down here to 2007, you may remember October, we had this whole start of the process where we learned about how mortgage bonds had been filled, those package programs had good and bad loans put together, and it just created a big meltdown. You'll note that we took a huge hit from 2007 to 2008. Then it came back up. So now by 2012, June or July, we're now back to even again, but then it takes off and it goes up very nicely. And things do pretty well. We have some pullbacks here. This is 2016. Here's 2018 where it kind of slows down a bit, but we take off. And then we get hit by the pandemic, where we have a pretty big hit, which you'll notice takes a big drop, has a huge drawdown, -34%, but it still wasn't as far as back to what we were in, say, 2015, 2016. That was a pretty short-lived downturn, though, because there was a lot of policies in place that really seemed to give people confidence they'd go forward, and we had an incredibly nice run-up, and that happened until we get to January of this year. And in January of this year, everything kind of started to get a little weird. It started to have problems. And so we can see again, drawdown. But what I'd also point out is where we are today. I guess this is only going to partway 21. I'll show you some stuff that updates further than that. But when we look at what we're seeing now, we're still not back to what we were back in the height just before the pandemic hit. And we're not anywhere near the downturn we had at the bottom of the pandemic, at the bottom of the stock market. Part of what I really wanted you to see, though, and I'm going to do this for the next slide, is that what we see here is valuation measures. And so what we're looking at is the forward price to earnings ratio on stocks. So the 25-year average is about 16.86 on price to earnings. That's what we look for. We think that companies are fairly valued based upon this average for the last 25 years. One standard deviation above is about $20.22 or 20.22 times price to earnings at that point. And one standard deviation less is about 13.5 times price to earnings. Well, you can see right now, after that high, we're down currently on June 16th to about 15.8, meaning that we're probably getting much closer to price to earnings. And that model tells us that if we break down here to the 13.5, 13.5 on the price to earnings ratio, that means that things are really valued. So my question is, notice here, 2008, we had some bad times, 2010, 11, but notice very rarely did we stay below there any length of time. And if you look at the times we're either above the average or even up there into the standard deviation, you can see that we may have seen a lot of the difficulty show itself at this point. Now, I'm going to tell you that I don't think this is the end of the discussion. I'm not sure that we have seen the end of it. I think probably there's some more to this we want to be aware of. I'm going to talk more about that as well. So as we look at, I'm going to jump through some of these to get to where I want to be. There we go. So when we look at intra-year declines, meaning what was the worst in that year, and that's identified by the red, and then we look at how it ended on the downturn. What you'll note is of these 42 years, 32 of them, going back to 1980, 32 of them were positive. And so we had 10 that were negative. And what you would also want you to see is that of that model, we had a year end down, for instance, here, this would be 81. It was, the year ended at negative 10, but it actually was as far as 18% down. Here's another, right there in 1990, down 7% for the year, but at one point, the mid-year intra decline was minus 20. This is 2001, 2002, and 2003. Again, we find similar behavior. The mid-year or the intra-year decline was way worse than how the year ended up. Nobody's excited about minus 23%, but it's better than minus 34. Here's 2008, minus 38 as how the year ended, which was terrible, but it was minus 50, 49% at the intra-year decline. Here is 2018, I believe, minus 6, but it was as far down as minus 20 at one point. And so far, year to date, we're down 23%. The worst case has so far been 24. It may get worse, but it may not get worse. I would also have you notice that there are very few times that it got worse than this. So when we look at the positive years and we see how many positive years there were, and we see the few negative years, and we recognize how the year ended versus how bad it was at some point during that year, it's a little early to call this game. And I think there's a tendency right now for people to think it may be over. I don't think it is. I think that what we need to do is be thinking carefully about what we do next. And that's part of what we're going to talk about as well tonight. Let's see here. Let's go to. So part of the problem that I think many people are faced with is consumer confidence. Many people are really struggling to have confidence that things are going to be better. And I'm not sure that has to do with politics as much as it does just policies and lack of solid information right now. And as I showed you on that one chart, there's virtually no sector other than commodities that's doing well right now. And I can remember how that felt at other times, like in 2008, where it was like, it didn't matter where you went, nothing was working. And it went through this period of time for roughly 6 to 9 months where it didn't matter what you did, nothing seemed to work well. And so we may be feeling that same kind of issue now with consumer confidence, because you can see here in June of 2022, our consumer confidence is as bad as it was clear back to 1980. Even in 2008, it wasn't that bad. Even in the pandemic, it wasn't as bad as it is now. So the real question is consumer confidence, which is sort of a lagging indicator to this whole thing. Is it real? Is it a fact? Or is it just a feeling? Is consumer confidence based upon facts, or is it based upon feelings? I'm sure every one of you on this webinar thinks that, well, it's based on facts. I certainly wouldn't be just operating on my feelings. But what I notice is that back in 2008, 2009, and 10, there was a lot of conversation I had with people that had much more to do with feelings, because they perceived that administration, its policies, to be focused on things that would tear up the country. And I feel there's a sense of that going on now. But just as we saw a moment ago, it did come back. And when it came back gangbusters. And so the question becomes, is it possible that it could come back again? And I think the answer is back to those goods that I told you a moment ago. The election certainly could have a positive impact on consumer confidence. If we start to go into, say, the next month or the next quarter, and we start to have much lower inflation, that's going to add a sense of positivity to people's thinking. It's going to add to consumer confidence. If we start to see some of the supply chain issues, some of the things that we've been trying to buy that I can't tell you people I talk to and like, I've been waiting months and months for this or that or whatever. And I'm one of those people. Those things, once that starts to change, I think that's going to add to consumer confidence. And those are pieces that we're only going to see as they start to unfold. But it's clear why people are so nervous right now, or uncomfortable or disappointed, because consumer confidence is at an all-time low. I mean, it's, it's serious right now as far as how people feel about things. But we have to ask ourselves, is feelings what we should be basing this on, or should we be looking more at facts? So with that, let's take a look at a few other things. We'll go to 29 here. So the oil markets, and I know that oil prices are high, no doubt about it. June 16th of 2022, we're looking at oil prices at $117 a barrel. I don't know if you remember it, but actually we had oil at $11.57 for 1 month back in April, just after the pandemic hit, because people weren't sure what this meant, how it was going to be, etc. You notice in October of 2018, oil was priced about $76 a barrel. If we go back to June to 2014, oil was priced at $106 a barrel, which that actually held on for quite a while there. That was part of the reason so many people were so uncomfortable. If we go back to 2008, we saw oil hit $145 a barrel. And so the point is that people are like, well, this could get much worse, and it could, no doubt about it. But it also may not be as bad, because if I direct you over to this chart, what you see is active rigs that are producing oil and inventory. Remember, I talked about supply and demand. Inventory is supply. Active rigs are replacing that supply. And as we get more and more active rigs going, and I understand the problem with that goes back to the elections again and how certain things could change. As we get more and more energy moving, that's going to have a huge impact on reducing inflation, because energy is a huge driver to inflation. There's another chart I could show you, but because of time, I'm not going to, that shows that how energy is probably one of the biggest pieces that drive inflation. So if energy costs come down, so will inflation. If inflation comes down, consumer confidence will feel better. As supply chain issues become resolved, that will then improve on that. So what looks so terrible in June may not look so bad in July or August or September. Now, it could look worse. There could be another couple of months of this, but sooner or later, it will come back, because it always does. Notice here in February of 2016, oil was down to $26.21 a barrel. Now, at that point, you might say, well, wait a second, couldn't we get back to that? Was that a good thing? No, because the truth is, the reason you're seeing active rigs improve or increase is because at this price, it's profitable for oil companies to start drilling. At this price, it's not. At this price, it's harder for them to make money. So what you're shooting for is somewhere here around $50 to $70 a barrel. At least that's what oil companies are looking for, because that means they can put all the money into drilling and hopefully finding the oil and then getting that oil processed and getting it out to us and then getting it refined, etc., and still make money at it. So what we're looking at here is a potential that as these active rigs keep coming online, that we may indeed see that oil price come down. We may indeed see inflation come down, which will then drive more positive thinking in consumer confidence, which will then drive the markets. So as we continue on this, we go to, I did show you this last time, but I want to take just a moment that we do see that interest rates are increasing, but we can see that the Fed has no intention of getting above 5%. That doesn't mean that they won't. They could find themselves put in a position where they think they need to. And I'm not saying that they're the best minds, the greatest minds there to make this happen. I'm not sure I think that. But what I would say is their expectation is that you're going to see it's going to hit a high of market expectations 3.57, FOMC long-term probably at 3.8, and then they look at hopefully bringing that back down again to make it so it is more profitable for corporations, more profitable for individuals to borrow money, and manageable as a model long-term for interest rates to function better for the country. Again, as interest rates are lower, while it does impact seniors and their ability to draw income, at the same time, it makes it so the markets can perform better because it's not slowing down. It's not a weight dragging down corporate profits or individual opportunity to buy property or make capital purchases. Finally, the last thing that I want to kind of take a moment at, and the reason I pulled this or decided to show you this chart is because I know that I'm expressing positive thoughts, and I think there is a lot of blue sky out there ahead of us that gives me confidence this isn't the end of the world. But I would say that there's something that I found this chart is a great way to sort of express what I think many people are feeling. And this is a comparison on 10-year treasuries, what we would call the nominal yield versus the real yield. And I want you to notice that from 1982, for instance, a lot of time the two charts, while they might have been a disparity between them, meaning that with real yields you have whatever the interest rate is minus the inflation, which gives you a real yield. And so you'll notice they follow along pretty well. But here we are, and lately in the last year or so, we have noticed a separation of those two, where real yields are going up, or sorry, nominal yields are going up, and real yields have been going down. Recently they've been going up, but that is a feeling that has led to this term stagflation. And the last time we really remember seeing that goes back into here. So here's the 70s, and we saw a huge separation, primarily because nominal yields were moving up, but inflation was eating up all the nominal yields, making the real term not nearly as good as it was. And we can see that while it broke above a little bit, it turned south again, and then this is the Carter presidency, and then this is where Reagan came in and started to bring some different policies in place. Again, this has nothing to do with politics, it has to do with policies and how policy writers, how policy leaders bring about change. So I think it's a good thing that we're seeing these two start to catch up, but I want to see this, meaning the real yield, get above zero, because as you can tell, nominal yields right now are 3.31%, while real yields are negative 2.71, meaning that inflation is eating up the difference. And that makes it hard for people to have confidence. I don't want to see this turn into this, because I think this is what we're worried about. This is that rising inflation and stagflation of the economy sort of put into a graph that's easy to understand. So one of the things that we're watching is, does this begin to move up because inflation gets better? If inflation stays where it's at, even with yields rising, it will be a problem, because we need to see inflation we need to see it reduce, and we need to see yields hold or rise a little bit. We can see here how those nominal yields have been over the period of time. We need to see those bump up a bit so that we can then feel confident that we're making money, and with inflation being where it should be, that we're actually keeping money. And so when I tell you all these positives I'm looking at, I also recognize that inflation may not go away as fast as I'm hoping. I'm realizing that oil prices may not come down for a while. I realize that if that happens, we're going to see a problem with nominal yields versus real yields as being problematic. And all these various pieces coming together could be a challenge for the market, in which we could see more negative downturn. So what I would say is I see a future with right now and say the next 6 months, 2 quarters, 3 quarters, a year, I see a lot of blue sky, but I also see some dark clouds out there that we need to be careful about. And that's part of why I wanted to spend some time tonight to say, hey, I think there's a lot of hope, but I also realize that we have to be cautious as we go forward and make decisions. As we do this, again, I'll probably spend more time, I went the wrong way, spend more time on these discussions in our future meetings, and hopefully we'll start to see things come across the line that are much better. This is fixed income sectors. Let's go to, actually there's a lot of cool data in here, but I could just bore you to death with some of it. Chinese, private equity global. Here we go. This is where I started out with the asset class returns. And so what I would say to you is depending upon how your asset allocation model is set up, you're seeing somewhere in this return, or you're seeing more if you got more aggressive, or less loss if you're more conservative. And so the point is that whatever discomfort or pain you're feeling, it's real, but then the question is it long term? You see, the discomfort is real, but when we have a loss like we see right now, that loss is what's called unrealized gains or unrealized loss. If your account goes down 10,000 because the share price is down, it's not a realized loss until we sell it out. Now, that's not a reason not to sell it out. That may well be a reason to make changes, but it's just a paper loss, much like if your account goes up $10,000 because the share prices go up. That's unrealized gain. The IRS doesn't tax you on that. They only tax you on it when you sell it. So what we have to do is decide when is it time to have our entry and exit strategies in place, and how do we base those decisions as we go forward here, which now kind of brings me back to what I wanted to share with you. So with that in mind, let's talk about a different term we haven't talked about before, which is called market capitulation. And market capitulation follows downtrends in the markets, which happen when more investors sell than buy. You might say, well, haven't we had that already? No, what happens is you have reactionary selling, you have reactionary behavior. Sometimes that's kicked off by program trading, sometimes it's kicked off by other factors that may or may not be real. Sometimes it's just overreaction. Matter of fact, if you look at where the value of price to earning ratios are in stocks right now, all it did was actually bring it down to what's more realistic. But if you think it's going to go back up, it also brought it down to a place where those are on sale now. If they can go back up to from a 15 price to earnings ratio to say a 22, that's a pretty good opportunity. And so you have to have confidence on when that's going to happen, or how you're going to take advantage of that. On the other hand, if 15 just seems maybe not that great a deal based on the economy and how terrible things are and what the policies are going to do, maybe that's when you have capitulation where it goes lower. And see, I think that there's a good possibility that with all the stuff that'll be coming over the next quarter or two, we might already have seen that and see an upside opportunity. But what causes capitulation? Fear, uncertainty, doubt, FUD, fear, uncertainty, doubt, which I think there's a fair amount of fear, uncertainty, and doubt right now. A bear market, which the S&P just went into bear territory. If it holds it, that would be a bear market. It's not just it hits there once, now it's bear. It has to stay there for an extended period of time. Poor earnings results for corporations. That's not really the issue at this point. Negative company news. That's really not what it is. It's more about the economy than anything else. Negative macroeconomic trends, which could be what we're experiencing right now. And that's why I'm showing you the issues about what's going on with the economy. So I would say at this point in time, fear, uncertainty, or doubt, FUD, I think that may be part of what we're experiencing, and then concerns about economic trends and where they're going. Now, the question really is are we going to experience capitulation? And that's really what I kind of wanted to spend some time on tonight. So what I did is I decided to expand a little bit further on the conversation I've had with you over the last year or two on how we handle different periods of time. So here is most recent time starting in January of this year. This is going back into 2008. Here's 2007 when the market reacted. I want to spend a little bit of energy talking about how we handled this to let you know what we're watching for here, because this is, I think this is very important. Not that these two times are the same, and as I've said before to you, history doesn't repeat itself necessarily, but it does rhyme. And so I want to make sure that you understand how we're processing information so that that either works for you, or if it doesn't, so we can make some discussion, we can have some conversations about it and have a discussion to decide if we want to make a change and do it slightly differently. So with that in mind, let me pull up here. Here we are. So this is that chart. Again, I realize that it's impossible for you to see all this. I mean, make your screen as big as you can. But again, if you really want to sit down and have a conversation with me about this, I'd be happy to. This is going back to 1999. You can see that 1999 is what we're looking at there. Here is 2000. Here is the 2001, 2, and 3. Here we have the drop. Here we have the come back up again, as I mentioned to you before. As you can tell, from this high in July of 2000, it wasn't until 2013, if you follow that line all the way across, that we made money. If all we did was just bought the S&P 500, not counting dividends, and stayed in there and did nothing else. If we count dividends, that would have helped bring those numbers up, and they might have been good, especially if they're being reinvested. If they're being spent, then it really wouldn't have had any positive effect. But once we got past 2013 or here, then we see the market go back up again. Now, as I've talked to you before, we don't really operate with a buy and hold. We operate with a grow and protect model. And if I could read the future, I would know when January hits that we need to make changes, but I can't. So like everybody else, we have to make decisions accordingly with entry and exit strategies, with asset cyclical market and how that works. And we don't do this on a day trading models. As any of you and I have talked, you realize we're not fans. I'm not a fan of day trading, but that doesn't mean I can't see trends and begin to take advantage of those trends to try to grow wealth, to protect it and grow it. So I want to go back to this time here, 2008, and break it out so you can see a little bit more realistically about how that functions. So I'm going to move this forward to 2007. Yeah, we'll go back here. Kind of hard to do that, but I appreciate you working with me on it. And then I'm going to move it. Let's see here. We'll go to, actually, because of the time we're doing, or because of the time span on this chart, I'm going to do it this way. Take it down to, yeah, that's not too bad right there. Okay. So what you're seeing here on this chart is you're seeing the high of the market. Let me inspect on there again. You're seeing the high of the market, which is October 2007. And as I've told you before, I remember for some reason that day like it just happened. I remember President Bush getting on television and talking about how, you know, everything was fine. There's some issues in the economy, and it had to do with how bank lending had worked in previous administrations over the last 5, 6, 7 years. I don't know if you remember, but housing prices were just going through the roof. Banks were lending money as fast as they could, and there were various issues that had come to light, although we didn't really understand it probably until about two years later, that what had happened was banks lent money to people they knew couldn't pay it back, not a lot of them, but enough. And when they put together their mortgage bonds to sell those, they put, you know, some bad loans in there with the good loans. And the problem was not there was too many. It should have been fine, but the problem was nobody could tell how many bad loans were packaged in with the good loans. And the data just wasn't really clear to help make that understandable. And it took years, several years, to actually break that out. We now have other metrics in place to help make it so that doesn't happen again, but it doesn't change the fact that in 2007, when there was this big fear about what was coming, I remember President Bush saying, just keep doing what you're doing, keep buying your stuff, keep living life, and this too shall pass. So I have to say, quite honestly, I kind of believed him in that and thought that kind of made sense. But as I'm watching the markets behave here, this is now November. market breaks through. And if I go backwards, you remember I showed you how it looked from say 2003 to 2007. It was like up, 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 up. And so it was like, okay, there's going to be some sort of challenge, recession, etc. And so the market went down, then it came back up. Now, as I told you before, the red line is the 200-day moving average. The blue line is the 50-day moving average. And so what we do is we watch how the daily activity bounces into those and then either breaks up and heads on up or breaks down, what we call convergence divergence. It converges into and then diverges either above or below. In this case, it went below. And so we move out here. This is now January of 2008. So again, we've got October, November, December, January, 4 months, which on the chart doesn't look like much at all. But when you're sitting here trying to make decisions, it seems like it's an eternity. And so then we're watching here, and the market tries to go up and comes back down, runs up, hits the 50-day moving average, goes south again. And by this time now we're into March. So now we're looking 6 months into this. And the data that's coming out is getting less and less comfortable. It's not good data, it's not terrible data, but it's not good data. And you begin to realize that something smells. You can't quite figure out what it is, but you know something's not right. And again, we look backwards and we know all the answers now, but back then in March of 2008, the answers weren't as obvious then. So here we move into the end of March and then April, and we see that it breaks above the 50-day moving average and takes off again. Now, this point right here was this point where from March to, and this is May, from March until May, 60 days, we're watching it, I'm watching it, all the people that we work with are watching it. And the point is at that piece is that I think it's either going to do convergence, divergence and take off, or it's going to go south. And the reason no one knows is because, again, the data in May still was questionable about what exactly was the real problem. We knew that bonds were not being treated properly. We knew that were called mortgage-backed bonds, which had been believed to be totally safe. Now we knew they weren't totally safe. We knew something was wrong. We'd by then learned how banks were packaging these things, and we didn't understand the depth. We just simply knew it could be terrible, but we didn't know. And so at this point in time is when we decided to make a decision. Now, back here, we had made some decisions and sold out of a few positions. At this point, when it hit the 200-day moving average and went south, by then, so you can tell here, here's the high in October. You can see we come out here where the markets are further down, but we'd made back, it was better than this. We decided it was time to go ahead and get much more conservative. So if you are a profile 6, we said, let's move to profile 4 or profile 3. If you're a profile 4, we looked at moving to a profile 3 or profile 2. If you're a profile 3, we looked at a profile 2, or in some cases, just going to cash. Because I didn't know what was coming next, I just knew it was a problem. And I think anybody that was watching this closely had a similar feeling, but selling out, and it makes it look like I was brilliant, I wasn't. I just recognized I didn't know what I was dealing with, and so I didn't want our clients to face anymore. So from back here, well, I'll go here, October to May, all these months was like watching water boil. We're just waiting for it to start. And I was hoping it was going to take off again, maybe hold its own, keep going. But when it head south, broke through the 50 and went lower, it was just obvious that it was time to make some changes. And even if those changes meant that it got here, even if we sold out up in here, what that meant was if this was where it stopped and took off again, we could get back in, we wouldn't lose anything. And then fortunately, we didn't have to follow this all the way down because we had moved out of positions back up in here, which means that we started out with more money when the day come that we decided to go ahead and put back in here. We actually were waiting until, I think it's probably a little bit in 2009 and then much more in 2010 before we felt comfortable, because there was just so much questionable policy and data to try to understand. Let me move this forward a little bit now. So we moved here and kind of got in, but didn't do a whole lot, kind of got in here, fell a bit, kind of got nervous and took off again. And then if I were to pull this back out, you can see that it ended up working out pretty good, because even though we'd worked through this process, which took 7 months of time, we actually were able to see some decent opportunity here. This is 2015-16, where it kind of slowed down again. And then we can see that as we move this to the end here, we had some good opportunity. Pandemic hit. Because of the fact, we hadn't seen a pandemic since, goodness gracious. Yeah, I mean, I wasn't alive, but back in the beginning 1900s, I just said we should pull back and get more conservative, which we did. And then somewhere down in here, we went ahead and invested again. So how does that relate to today? Because that's really what the question is, isn't it? How does that relate to today? So here's what I would tell you. This happened. Let me turn the marker on again. So this happened. Market dropped. Didn't think it was too bad. Kind of held its own. Didn't think it was too bad. It's continued to hit. Inflation numbers come out. It's continuing to hit. And so here we are now in June. And then the question becomes the good data that I just talked to you about, the potential for inflation to work itself out, the potential for supply chain issues to work themselves out, et cetera, et cetera. I think all those pieces mean that we are either A, going to see a return here somewhere in the next 2, 3, 4 months. Remember, this is January. We're only 6 months in. It might take another 2 or 3 months before we start to see things. We move towards the election. I think when positive feelings come in, whether that's a reduction in inflation, an inflationary report comes out that says, hey, look, inflation's going down. Oil prices drop the pump. Hey, look, that's a positive sign. Various pieces like that can change this. And what we're doing is watching what happens as it begins to move back up again when it does. If the data doesn't look good, like recession is still looming out there, chances are we're going to go ahead and pull back, because why pull back when it's at a low when we could pull back at a higher rate and have more money in hand? Again, this is just an exit strategy that we operate with every day, every month, every quarter, trying to figure out the best solution. If you have a different exit strategy you want me to consider, you're the boss, I'm the employee, we'll do that. But I'm telling you that I'm very confident that we're going to see some sort of a positive reaction here in the next few months that's going to push it back up, whether it runs into the 50-day moving average and holds off, or breaks through and goes to the 200-day moving average. That sort of technical analysis, I think, has shown itself over and over and over again, whether or not it's in the pandemic, or if I go back a little further to 2018, which, by the way, we didn't do much with. This is 2018, that fourth quarter dropped down, watched it. The economic data wasn't that bad, quite honestly, so we didn't do anything. And quite honestly, it came back pretty quickly, rolls forward. Again, the charts make it look like it's just moments, but it's not. It's months and months and months. So you hit pandemic and so on. So this is part of how we maintain entry and exit strategies. If capitulation happens, capitulation will be because it runs up here, hits the moving average, one of these areas, and then turns south, and everybody's like, that's it, it's over, and they move out like they did in 2008. And so that's part of how we're running our portfolio management at this time. Doing diversified portfolios, watching for trends, and then taking advantage of those trends when they happen. So now let me go back to what I was sharing with you before. Here we go. All right. So technical analytics indicate that right now we're not running scared. We're watching and trying to read data accurately and make decisions accordingly. But as always, if you want to have a conversation about that, I'm more than happy to do that. As I already shared with you, historical market returns, and we talked about this back when we had Lincoln Level Advantage on, they talked about out of 529 6-year periods of time. I know I've been talking year over year over year, but out of 529 6-year periods of time, 465 of those 6-year rolling windows were positive, and 64 of them were negative. 6-year windows, positive up 87.9%, negative down 12.1%. So the reality is, if the S&P 500 is watched over a longer period of time, those trends can easily or more easily be identified, and then you can take actions accordingly. And so that's part of what we do as well. And then in the choice of asset management, whether or not it's the S&P 500 or it's any of the other groups that we work with, cash, bonds, stocks, real estate, commodities, or precious metals, energy, etc., hard assets. Various assets that we use are designed to act as correlators that either go with or oppose what you see in the S&P 500. So again, I think time's on our side in that case. So what's this say to you? As I've said the last 2 webinars, portfolio management options. If you have questions or you're concerned, please reach out to me. I'm happy to talk with you, or any of our team will. Our choices are: 1, utilize assets and securities that are negative correlators to the overall equities market. If you're like, I don't know if I can do this anymore, then we can make adjustments. 2, adjust the portfolios to more conservative positions quicker, immediately, to protect against further portfolio erosion. I don't think that the numbers are that bad at this point, even though I know they're not good, and nobody's happy with a negative 10 or a negative 15 or a negative 20. The more aggressive the portfolio, but then the other side is when it does turn, it'll work out. And then finally, as we're doing here, and we'll do with you anytime you want to, continue reviewing fundamental and technical analysis and adjust the portfolios when we think that data supports making that adjustment, much like I just showed you a moment ago. So as a reminder, I try to give you some insight into what we're thinking, but I also want you to remind you of what I'm excited about, which is our new website that's coming on. I did tell you that I thought it would be up and running because of COVID and some other challenges and vacations. It wasn't up and running this week, but I'm being told that it should be up and running by the end of this week. So I'm looking forward to that. You're going to be able to use our wealth management apps right from that place. As a matter of fact, let me just quickly go over there and show you that, because I just so excited about how that's going to work. It's down here. So this is the old, all right, this is the old website. This will be turning off, and this is what will be turning on. And on there, one of the areas you'll be able to go to is the client login, and you'll click on that. And regarding those wealth management apps, all 4 of them are right here. So instead of you have to remember where they all are, everything, you'll just have to have your passwords, and you'll be able to go into your wealth management dashboard. You'll be able to go into your portfolio management dashboard. You'll be able to look at your Riskalyze scoring for risk and reward evaluation, and you'll be able to do your financial life plan for those that have planning with us. These pieces together will make it so that you can have just sort of a one-stop shop on what you're doing. So that's one of the things I'm excited about. Also, there's going to be all kinds of opportunities where we're going to be able to have resources that you're going to be able to access, log in planning calculators for our guests, complimentary consultations. So you can just click on that, and you can, we'll be happy to schedule time with you. Services, how we work with entrepreneurs, individuals, and families, and then retirees. Educational resources. All the things that we talk about here, plus helping you to understand how to implement. They're going to be coming with videos that I'm going to do that'll help to explain how we do what we do, so that even if you're not on the webinar with me, you'll be able to what do you say about that, and go to investments and be able to see in more detail what it is I'm talking about. So I'm incredibly excited about what that's going to look like, and how that comes online this week should be phenomenal. So I'm excited about it anyway. Also, that same website is going to be phone and tablet friendly. So if you don't have your computer handy, but you got your phone, you can go there. And the way it's built, it'll be easy to operate on your phone. We're going to continue to build these videos for family and finances, have blogs and vlogs. Matter of fact, one of the things I think Stephanie's working on right now is we were interviewed for an article as just a handful of advisors asking how we're handling certain issues. And so we're going to get that out to you either on the website or email, depending upon what the broker-dealer says. And then even develop a YouTube channel with all the videos we're going to have, so you'll be able to watch that. Plus, I'm going to stop there because it's just a number of things we're going to be introducing, but there are going to be more pieces. Matter of fact, for instance, one thing in our growth phase that we're in, we just added a new state that now we're working in as well. So we're up to, I think, 25 states that we serve clients in. And you might say, well, how can you handle all that? We got an amazing team. We really do. I couldn't do it by myself, but with all their help, it really works well. So how should you diversify? Well, hopefully, based on everything that we've been talking about, not today, but long before today, you're set up properly with how much cash reserve, how much you want in bonds or conservative assets, equities, real estate, tangibles, currency, business interests. All these pieces hopefully you're diversified well. But if you're concerned that maybe your diversification is too risky for who you are, give me a call so we can sit down and talk about that and help explain how to put that in right order for you. If you are not using the apps, which I think most everybody other than the guests are using the apps, this is your wealth management dashboard. This is your portfolio management dashboard. This is the risk reward analyzer, so you can make sure that your portfolios are matching your risk tolerance. And this is your life transitions, life goals for how this is the feelings and this is the facts of your financial plan. So if you're not using all these, please let us know. I'd love to get those in your hands because I think they'll help you a lot. As always, if you have any questions, this is that time. I see a question just popped up. Let's see what that is. I'm going to do that right now. Okay, you are great. Thank you. However, with your view on blue skies ahead and with your cautions noted, how great do you think Jamie Dimon's weather forecast was? You're welcome, Simon. What I would say is this: I don't think that what I showed you has anything to do with what Jamie Dimon thinks. He's got thoughts, I know that, and I've heard those, but no, what I was showing you tonight, very good question, Simon. That's the raw data. That's all this is. This has nothing to do with what he's saying, but rather what the data is showing and my interpretation of it. Plus, as I've said before, we have 14 other resources that we draw, or 13 other resources that we draw from, all designed to help us see what's going on. Because, you know, it's so easy to choose to listen to people that I like what they're saying. You know how you hear what's called confirmation bias, that people who listen to Fox News hate the others, and people listen to CNN hate Fox. I don't have that luxury. I have to look at all of it. So we look at what people we agree with are saying, what people we disagree with are saying. But whenever I can, I look for raw data because I think that is the more important determiner in what we're doing. Okay, so Anne has a question. Let's see if I can unmute you. Anne, you have to unmute. I'll say I've unmuted you, but you have to also hit unmute so you can talk, so we can hear you. I'm not sure if you can do that. Where did we go? You're not there now. Oh, looks like Anne shut. Oh no, there she is. Okay. Anne, if you want, you can just go to the chat box and type in there, and I'll be happy to answer your question that way. Again, go down here. So down there where there is a little box down there, it says chat, and that's where all the chat is. And then you can go in there and you can type to the entire audience and so on. So we got a pretty big group on here tonight. I'm going to watch and see, Anne, if your question pops up, because I'm going to be ready to do it. All right, so until I see that question, I'm going to keep going here, but I will watch before we close off. So again, if you have questions, you can certainly do them on this webinar if you can get the online chat working for you or whatever. If you want to, though, feel free to just email me questions, and I'll be happy to give you a call and answer those at your leisure as well. So our next investor update is going to be July 19th. And on that, we're going to be talking about two things. Hopefully, I'll have some better market update information that kind of shows some things coming together that we talked about. But we're also going to spend some energy talking about estate design and some basics for helping you think about how your accounts are set up with us, how you've got your will or your trust set up, how to kind of look at going forward with that. And so I'm going to spend approximately 20 minutes going over some of the basics of what we do, helping people in their financial plan to maximize their estate design. Because I've talked with several people lately who their estate designs are out of date or things have changed, they haven't updated. And even in some of our cases, we've talked with people, we found that there's things we needed to help them update in our accounts to make sure everything was matching well for them. So we're going to talk about market update as well as how to do that transition part wisely, both while you're alive, as you deal with end of life issues, and then transfer issues. So that'll be part of what I'm going to cover on July 19th. So please be part of that as well. So what we reviewed so far, what we believe, market economic review, and yes, I do see blue sky, but I'm not listening to Jamie Dimon, I'm just looking at the data. And so I also see some dark clouds, so we're watching carefully for both. Hopefully now you kind of understand a little bit more about how our exit strategies work, and especially as we look forward to a recession, or don't look forward to it, but recognize it's very strongly could be an eventuality. How we diversify portfolios. Again, there are so many options that I'm going to actually start doing some videos here before the end of the year to show you how all the options work together, because knowledge is power, and if you know what we can do, maybe you haven't had a chance to see it all. Hopefully this will help with that. The new website and educational programs, which is part of where that will come into play to get that information in your hands. If you're not using the wealth management apps, please do let us know. We'd love to help you with that. Had one question. I don't know if Ann, if I'm looking over here, did you, oh, let me go back. Just want to make sure if you got your, nope, doesn't look like there's a question right now. All right, if you do though, feel free to reach out to us by email. Certainly, if you have friends you'd like to invite to this, feel free to do so. You can email Sherilyn@franksoffice.com, and we will be happy to get your guests an invitation so they can join us. And we'd love to have their input on this as well. And so to those of you who are clients who've been with us for a number of years, or even some of the newer clients, thank you so much. I cannot tell you how much we appreciate you. And to the guests, we look forward to talking more with you, answering questions, and helping you create, grow, protect, and preserve wealth for you and your family, both today and in the future. So that brings me to the end. I don't see any questions yet. I hope you understand that while I don't think it's all perfect and daisies and sunshine out there, I am excited and hopeful on how things are going to look as we move over the next 12 months, that there's going to be some opportunities to make money, and even more so if we go through some challenging times, that out of that there's going to be even more opportunities to make money, like we saw in 2001 and 2008, and I think even with the pandemic, opportunities there. So that's my goal, to look for those and to be ready to take advantage of those as you seek to make the most of what you're doing with managing your family wealth. So since I still don't see any other questions, I'm just going to close it out now and say, God bless America, God bless you and your family, and I hope you have a fantastic week, and I look forward to talking to you soon. If, again, you have any questions, we're here for you, as always. So have a fantastic night, and I will look forward to talking to you when you get a chance. Thank you so much, and have a great evening.